Okay, welcome to Swing Trading with Cycles. We're going to do a Cycles 101, a stock market cycle analysis here, just helping you understand how to conduct that. How to, some people may call it time cycle technical analysis, which in some cases uses some other methods and I'll talk about that. I focus very exclusively on open, high, low, close, OHLC. Those are the levels, and really levels or zones. We'll talk about that. But it gives you a sense of where you might see a reversal, either bearish or bullish sort of thing. And so let's get into it. First off, to understand about stock market cycle analysis is that it needs to happen from low to low. You're looking at a cycle from low to low, from one low to the next, and the high can happen at any time. The reality is the low doesn't have to happen on a scheduled basis either. That's a thing that I think people fall into, sort of a trap, in terms of thinking that, if you're doing cycle analysis trading, you know exactly when the low is going to happen, and so you're just kind of waiting for that. That's not how you want to approach it. You want to think about, you're really looking at the price action, which is what we're gonna talk through. And so we're going to use the Dixie as our example here. We're looking at the highest time frame you can really look at, which are yearly candles. So every candle here is an entire year of price action. So, really the highest time frame you can look at. And so this goes back to 1967, and we'll think about cycles exist on all time frames, right? So this is a yearly chart. You could go down to an hourly chart. You can go down obviously much lower than that. In general, cycles exist at every level because they're just a natural phenomenon. And I don't mean that in sort of a mystical way. I really just mean cycles help to categorize how price moves in sort of trend. In the case of this, in the case of the Dixie, it's been more. It hasn't been much of a trend as much as a range, which is not surprising because it's a currency. But if you think about like a trend, like this went up here, then went down there, then came up here, then went down here, right? Then we went all the way up here, then we came down here, then we went up here, then we went down there, then we went up here, then we went down there. We went up there, then we went down there, 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 there. So far here. We'll see where it stops, but think about that. So we made, and that's the thing. This is kind of a choppy range essentially, but we made this low, then we made this high, which is lower than this high, which means it's a lower high. So we're trending lower. And then we made this low, which is a lower low. So that's telling you, okay, uh-oh. But then we had this multi-year period of moving higher, made a much higher high way above here. But then we just gave it all back, just completely collapsed. Then made a lower high, and then made another lower low. And then we had this little multiple year period where we trended higher. You can see we made this higher low, and then we kept going. But then we made a lower low below here, and then so this is really amounting to a large, again, thinking about this is going all the way back to 1967. So we're talking about, what is that, like 40 years, 50 years, right? Like, so we haven't really, it's a currency, so you wouldn't expect it to be like, on an upward trend like Amazon stock, for instance, or something like that. But this kind of blow off, and I'll get rid of this now. And we'll talk about the actual cycles, right? So this is your first major low, this candle right here, and we'll zoom in. And so the first thing that you want to be aware of is the way you spot a low is what's called a swing low. It's a technical term. It means you have to cross, in this case, right, above the low or excuse me, the high of the candle that marks the low. So we're zooming in here. So this, you have this drop here, right? And let's actually just measure it. So let's say from here down to here, you dropped 32%. And of course, this is, again, a basket of currencies against each other. So, but the value of the dollar against that basket of currencies dropped 30% in this multi-year period, right? Into this low in 1978, right? And then we consolidated for a whole year in the year of 1979. Really just didn't do anything. This is a very bearish looking candle, though. Looked really awful. But then 1980, bullish outside candle. Zoom in. Let's make sure we understand what that means. It means this candle made a low relative to this candle, right? So we went below this low. But then it made a high above this candle as well and closed green. So it's a bullish outside candle. Makes a new low and a new high at the same time, but goes green. And then you had 1, 2, 3, 4 years of just green, higher high, higher high, higher high, higher high, right? So that cycle bottom happened here, and you can just, this is a 12-year decline, because again, each of these candles is 12 years. Or excuse me, each of these candles is a year, right? And so in that 12-year period, you have a decline over about 30, just a little over 32%. And then you have this period where you rise for 7 years. So that's 1, 2, 3, 4, 5, 6. And then this is year 7. And this is important. If you're new to this channel, definitely take a look at the rest of the videos. This is a really, and subscribe, please, like if you find value. This is a really important concept, this idea of a bearish outside candle, right? The same way this was a bullish outside candle, made a new low, made a new high, closed green. This did the exact opposite. Made a new high, but then it went red and it made a massive new low. The other really important thing to understand is that, and we'll talk about this as we zoom into the lower time frames, candles transform and change as they're sort of forming before they solidify. So this is obviously a closed candle. This is 1985. It happened. But there was a point where it wasn't a closed candle. Like, let's say January, February, March of 1985, it was a green candle. How do we know that? Because of this upper wick, right? Because this upper wick means it was above this high. Because, well, let's just be really clear. This candle means it opened here, right? Right where this body starts. That's at, 152. And obviously these are levels much higher than where we are right now. And we'll get to that. So it opened at 152. But then the high was 164.72. So it opened at 152, but at some point it went as much as 10 points higher, which is huge for a currency. So all that to say, it had a blow off top in 1985, right? The Dixie did. And then it just came down and reversed hard, and it closed at 123.46, which was basically at the lows, just a few basis points off the lows. That for the year, that is. This is an entire year of price action again. So massive fake breakout, if you will, right? That's what that is. That's a fake breakout, a false breakout, whatever you want to call it. We made a new high, and I mean, again, at one point in 1985, in real time, it looked really bullish. I mean, of course, obviously you didn't have TradingView. You certainly didn't have it on a phone in your pocket, but that's what happened, right? And then we got this massive green bearish follow through in 1986, and then we got more follow through in 1987, and then we just kind of chopped around down here, really ugly stuff. Made another new low in 1990, and then really ugly candle in 91, and then finally made that final low. And that, so going back to that idea of the cycle, right? We rallied for 7 months, or excuse me, sorry, 7 years, excuse me. Every candle is a year. So we rallied for 7 years. That seventh year was 1985, where we went bearish outside. Then we declined, right, for, 1 year, 2 years, 3 years, 4 years, 5 years, 6 years, 7. And that was the 14th year of this cycle. So this cycle was 14 years is the way to think about it, right? So this cycle was actually kind of perfectly even. We rose for 7 years, and then we fell for 7 years because the cycle was 14 years in length. The high came on year 7, and the low came on year 14, right? So 7 years rising, 7 years declining. That's the general way you want to think about a cycle. And you can definitely take a look at the links in the description for just a write-up on cycles if that is helpful for you, if you prefer written form. But that's an important way to think about it, advancing versus declining. So every cycle starts by advancing, right? So we advanced for 7 years, and then we declined for 7 years. That's obviously not very positive. That's not very bullish to decline for the same number of years that you advanced, right? And then if you think about what happened from there, right? So we got our low in 1992. Then we got some bullish followed through in 1993. But then we got 2 years of red, right? That was not looking great. But then we got a bullish reversal. And then we kept running higher up until year 9, which was 2001. Not a coincidence. This was right around the sort of 2000 bubble, right? And so this rally, which was huge, and let's actually quantify that, right? From this low to this high, wow. So, right, that makes sense, right? It doubled. And again, this is an index that is looking at the relative strength of currencies against each other. So for it to double is a little bit of an esoteric thing. Obviously, if you had a trade on, you'd have made a lot of money. But this had a huge rally from there to there. And we have a rally to the, 9-year top here at 54%. So this rally from this low to this high, and that's how you think about these things, right? From the low of the last cycle to the high of the current cycle. That's how you measure them. This was 100%. Then we have this huge drop, which, let's quantify that, right? So the drop was 52%. And then we rose 54%. But notice, like, big picture, this is just a lower high of this, right? This is a rally that gave way as a lower high of this, right? 54%, very, very, very impressive rally. But, that's over the course of 9 years, right? And that's following this massive 50% decline over the course of, 7 years. So that's important. That's important context. All this to say, this is the largest time frame cycle you can kind of, well, that's not, there are larger cycles if you want to even look at the S&P going back to like the Great Depression kind of thing. But this is, if you think about it, the quote unquote 15-year dollar index cycle. So we got this top on year 9, and then we drop into our low in 2008, year 16, right? Again, so these cycles aren't going to work perfectly, like exactly where, in terms of like, oh, well, it has to be exactly 15 years, for instance. And now that takes us to where we are right now, right? So we are right now on year 14 of the current 15-year cycle. There's no other way to really look at it. if you're thinking about it in terms of price action. I really don't look at the like Fibonacci, certainly not like the moon cycles or something in retrograde or anything like that. I'm looking at price action structure. This is a rally. This is a little bit of a bull flag. This is a breakout. At some point, this thing needs to pull back, and then we make our next move higher for that, long-term cycle. Now, this is year 14. We know this one ended on year 16. There's no reason why we couldn't get a low on like year 17, even 18. So we could get some kind of crazy downside like this, which at some point we're going to get something crazy because this has been a really furious rally. And so at some point we're going to get a pullback. But you would think we at least kind of sort of test this area, which would be 120. And we're right now around 112. We're probably moving into a weekly cycle low, which we're going to talk about. We're going to drill into that. So a better buying opportunity probably will await. But that's the way to kind of think about it. And that's the way to use cycles to your advantage. At this point, we're getting really close to a high, right? But because we're talking about a really long-term cycle, that means we could be talking about another 7, 8, 9 months of still going higher before we get that high. So let's zoom in as we speak of that to let's call it the 3-year cycle. So we are right now, so a 3-year cycle would mean 36 months, right? 3 years, 36 months. We are now in month 20 of this current cycle. And the way this works is these numbers, this number is the number of the month, right? So this last 3-year cycle ended on month 35. So didn't quite end on month 36, ended right 1 month early, if you will. That was January 2021. And so since then, we've been rallying. We had this little scary, like what you call a back test, right? Where it looked like, oh, maybe we're going to collapse. But then we had this bullish candle in June 2021. And then we just kept moving higher. Higher lows, higher highs, higher lows, higher highs, higher lows, kept moving. And now we are in month 20. Now, because of this huge upper wick, October is going to open as an inside month, right? It's going to open inside this wick, and we're going to see what happens. Does it break down to the downside? Because we're going to zoom in to see how the weekly cycle looks. But this is telling us about the 3-year cycle, right? And so we're on month 20 of a 36-month cycle. So as we thought about that last huge, like larger cycle of 15 years, we had that seven-year advance and the 7-year decline. If this cycle were going to be a perfect balance, it would be 18 years up, 18 years down. We've already risen 20 years. Or excuse me, we've already risen 20 months, right? And so that tells you, obviously, we're not early in the cycle, but there's no reason why we couldn't run for another, let's say we can go to 25 months and then we decline for 11 or 12 months or even 10. That would be perfectly reasonable. And to really kind of understand what is reasonable, we look at past examples. So the same way we categorize those 15-year spans, we are categorizing the 3-year cycle here for the most part. And I know this is where it gets a little bit micro, right? Because this is where you have to understand how to read price action. And I talked about swing lows, right? And so as an example, this is your low from February 2018. And we know it's our low once we crossed above the high from this candle, right? Because this candle marks the low, and the high from this candle tells us we're now making higher lows. That's how it works. That's what a swing low is, right? And so that's how we knew we were above that, right? And for this candle, the same thing, right? If I'll zoom in, right? So this marks a low, and we needed to break above it. So it took us 2 months to get there. But that's what we're going to be looking for, right? And on lower time frames in this case, because here we're still very green. And that's another thing to understand. The lower time frames ultimately trigger and make the higher time frames do things. You have enough bearishness on the lower time frame, the higher time frame will become bearish eventually, right? That's how that's how the multiple time frame analysis works. And so that's how you think about the monthly, or excuse me, the 3-year cycle, the longer term cycle. And if we drill down to the weekly cycle, we are now on week 17. And the same way we talked about how a swing low is set by going above the high that marks the low, the high of the candle that marks the low. And for a swing high, you go below the low of the candle that marks the high. And in this case, this candle is really like just kind of really standing out to you, right? That is week 17. We're setting up for a potential swing high starting next week. So the first weekly candle for October hasn't opened yet, so we're going to get that on Monday, and we'll see if that's what comes to pass. Here's a perfect example of where we got one again on exactly week 17. We had our swing high once we crossed below that low, right? So this thing closed below that. Again, we'll zoom in, make sure you can see that. So this candle closed below that, and then we had bearish follow through. But then we have this candle that just consolidated, and then this took us back up, right? So you want to be watching very closely. That's the point of cycles, not to be rigid and say, oh, this thing needs to bottom on this week. It's more of to understand there's a rhythm to things, and let me use the price action to be my guide. So as we're watching this, we would expect that we get a move below the low of this candle, which is 112 spot 173. And from there, you would really want to hold, like I want to say like right there, right? Around the 107, 108 area, right? Like if we went much lower than that, that would be a little bit concerning. Might tell you maybe we go even a little bit deeper. And if we zoom in even further, we get the daily cycle, right? So that was the weekly cycle, and this is our daily cycle. So again, the same principle. That was day 31. This was day 23. This was day 20. This was day 43. The tops are also marked. The top came on day 32, on day 12, on day 12 here. This was a bearish cycle, right? This was an ICL. Day 19 here. This is day 11 so far. We tried to get a little bit of a bullish reversal on day 13. We're going to see what happens as we open tomorrow. So Dixie opens 8 p.m. tomorrow, Sunday, October 3rd. And with downside expected for the market, you would think that we may get a rally, right? This may end up just being a relatively shallow pullback, because this is your 10-period moving average here, right? And so this is generally your gauge when you're thinking about cycle analysis. Your cycle low is always going to drop below the 10-period moving average, which makes sense because it's a short-term moving average. So as you lose the uptrend, you're certainly going to fall below your 10-period moving average. And so that's a good kind of way of thinking about it. And that's true on all time frames, right? I should have mentioned that. This is your weekly. That's your 10-period moving average, right? And so that's another thing to be aware of, right? This is week 17, which means we're relatively late in the weekly cycle, and we're going to get a pullback. The pullback almost always bottoms below the 10-period moving average. In this case, it's this line here. You can see how much higher this is above that, which is why I suspect we have a date with like the 108 area, right? Again, we see that some point early to mid-October, and then we see can we hold that higher low? If we can, this thing is probably going to 120, which is that level we talked about, like right here, right? Retesting that zone. Now, if it breaks through that or not is the real question. And that's where you want to really think about cycles, right? Because that means this weekly cycle is probably topped out, and so we'll have to see where that low prints. But this next weekly cycle is probably the one that takes us to 120. And then it's a question of how does the pullback from that weekly cycle look? Does that one possibly take us anywhere near that 160 sort of stratospheric area in 1985, right? That's your real question. That would be a huge wrecking ball to all assets, and definitely, I'll post a link to the video to the playlist about the dollar itself, because right now it's very topical. Early October, it is a wrecking ball for all assets, and so that is the general idea of how you think about cycles. You watch for a swing high, which means a candle that marks a high, and then you have a subsequent candle that moves below the low of that candle. And you know a low when you have a candle that marks a low, and then a subsequent candle moves above the high of that same candle. You've set some kind of low, and that also gives you a sense of where you can set your stop loss, right? Whether you're going, for a long or short. And the other kind of idea are trend lines. Again, I'm not a huge sort of fan of them, but like there's this idea things break trend lines, right? And so you would expect this thing is probably going to come back and kind of kiss this kind of thing, right? You can kind of see in past declines, it hasn't even really gotten there, right? Because it's been really bullish. And so that's why the trend line can be a little bit dubious, but it is still a helpful kind of rule of thumb. You can also even kind of see some kind of channel action here and say, oh, this is a false breakout, right? Like there are a lot of ways to kind of interpret that, which is also why I think it can be a little bit dubious, a little bit like what do you call it, subjective, if you will, right? Like you see a lot of channel work. That's why this I like the cycle approach, because it is really based on looking at those higher highs, higher lows, and then applying the OHLC factor to it. And so we'll leave it at that for this one. Definitely some follow-up material to come, but that is your general way to think about, stock market cycle analysis. Also, again, called time cycle technical analysis, sometimes called market cycle analysis, all the same kind of idea. You want to get a sense of how those ebbs and flows work in your advantage.